As we're looking at some of the risks heading into 2025, what do you see as the top risks and how should investors be preparing for it?
The one I'm being asked about the most is the tariffs, and we've heard huge numbers being thrown out there. 60% tariffs on China, 20% across the board tariffs, 200% tariffs on John Deere tractors made in Mexico, 100% tariffs on countries that, quote, leave the dollar. I'm not really sure what that means exactly, but if you add all these up, it could bring the weighted average US tariff to 26%. Way above 2.6% now, which is what it is. That could be above those Smoot-Hawley tariff levels that preceded the Great Depression. So there's reason for concern. We think the actual policies that will be implemented will be way smaller than that. And so I think investors may not need to make major changes in their portfolios. Currencies very rapidly adjust to tariffs. And so I think the weighted average tariff could go up 5% or so. The dollar's already gone up 5% or so, mitigating some of the impact of that. So perhaps major changes are not necessary.
So what are you looking at in terms of how you're defining the base case for some of the policies that may be implemented, especially when you look at some of the range of tariffs that were mentioned on the campaign trail during the campaign?
I think they could lead to trade deals. We saw a phase one trade deal with China during Trump's first administration. Sure, there were tariffs, but we also got a phase one trade deal. We got the USMCA as opposed to tariffs on Canada and Mexico. We got other trade deals as well. So I look at Europe as an example of this. So Europe just had slapped 45% tariffs on electric vehicles coming from China on October 28th. Days later, Chinese negotiators were in Europe working out a way to get rid of those tariffs and maybe have quotas or maybe a minimum price level for some of those cars coming in. And I think that's what comes out of this, something less disruptive to global supply chains and sales as a result. So we might hear about some of these tariffs as threats, but what might actually be implemented might be something different, maybe even quotas or price levels as opposed to actual tariffs coming in the door.
And I'm sure, a lot of clients probably wondering, probably panicked a little bit as they're looking at the environment here, wondering which policies will get implemented. Historically, what are the expectations when we look at the aftermath of an election versus what actually happens?
It's fascinating to look back, right? So if you take a look at the 2016 election and Trump's first term, in 2017, going into that year, the expectations were that domestically oriented U.S. small caps would be the best performers because of the America First policies, and maybe emerging market stocks because of the trade issues would be some of the worst performers. In fact, it was completely the opposite. Emerging market stocks were up nearly 30% in 2017. International developed stocks followed that, then U.S. large cap stocks, then followed by small cap stocks. So it's funny how things play out, and it really is more about economics than politics. I've always said economics have more of an impact on political outcomes than the other way around, and that's what we saw in 2017 when the global economy picked up some momentum and we saw more economically sensitive emerging market stocks do well. And I'd point out this year, going into 2015, while the US and China are expected to slow, most of the world's major economies are actually expected to pick up growth, accelerate in 2025. So that could be important as it relates to relative performance.
So then you mentioned some of these sort of counterintuitive trends that we tend to see. How should investors position their portfolios then when you look at the opportunities, and as you mentioned, in places like Europe?
So I'm looking for diversification away from really what's been the dominant theme in the US, which is just about tech leadership, particularly AI leadership, which used to be a theme, now it's like one stock. If you look to Europe or even anywhere outside the US, financials are now the best performing sector outside the US. It's moved away from tech, so it's broadened already. I think that's something we could see in the US as well as we get clear rate cut beneficiaries beginning to take leadership. Financials have a much larger weighting outside the US than inside the US. So if we see that sector begin to lead, we could see international stocks actually perform pretty well next year. So I'm looking to Europe as actually a pretty bright spot where we get price to earnings ratios begin to rise and earnings growth begin to accelerate as opposed to what we've seen the last couple of years where it's been the opposite.
And we know that we're always going to hear about AI, whether it's at events like this, whether it's the client experience and how that's impacting things. How do you see it impacting when you look at global strategy and perhaps some of the changing supply chains that would also come in 2025? How are you advising clients to navigate this space?
That's a great question. So AI has the potential to affect so many different businesses and really improve productivity in areas where maybe it's been lagging for a while. There are a number of major economies in the world where the demographics don't look good, and so productivity growth is going to be incredibly important, and that's where I think you could see greater implementation of AI. We've seen countries like Japan really embrace robotics and AI, and it's really important in an economy that hasn't seen labor market growth in nearly 20 years. So that's going to be really important and could be a big factor next year. So I'm watching the investment trends in AI. What are the businesses really pouring money into AI to get those productivity advances 1 or 2 or 3 years later? And I'm finding more of those actually outside the US than inside.
And just very quickly, any of these economies that you're seeing relying so heavily on these sort of new and advanced investments that some of the underpinning things that grow an economy are being neglected?
I think China is an economy where there's this misallocation of capital, right? They're really focused on some of these new trends, like AI, like semiconductors and green technology, to the detriment of supporting the consumers in the housing market, which are really the problem in China right now. And that's another one of the reasons why the world's #2 economy is probably going to continue to slow next year.
Jeffrey Kleintop, always great to get time with you. Appreciate you taking the time. That does it for us here. Back to you guys in the studio.